M&B Engineering, one of India's leading companies in the pre-engineered buildings industry. Now, what exactly are pre-engineered buildings? These are buildings that are designed and manufactured in a factory and then assembled at the site. They are faster to build, cost-effective, and very durable, ideal for industries that need strong and efficient structures. MBEL has an impressive installed capacity, meaning the maximum amount it can produce, of 1,03,800 metric tons per annum for PEB structures. In simpler terms, they can build a huge amount of steel structures every year. They also deliver 18 lakh square meters per year of self-supported roofing, which refers to large steel roofs that don't need beams or columns in the middle, giving more open space underneath. The company operates through two powerful divisions. First is the Phoenix division. This division offers complete PEB solutions. That includes complex structural steel components, which are the strong steel parts that make up the framework of large buildings. They also provide turnkey services. That means they handle everything from start to finish, including design, engineering, manufacturing, and even the erection, which is the process of putting the building together on site. Next is the ProFlex division, which focuses on self-supported steel roofing systems. These roofs are perfect for large spaces like warehouses, factories, and sports complexes. ProFlex delivers both large-scale and customized solutions, meaning they can build roofs according to specific needs of each client. Company serves a wide range of industries. These include general engineering and manufacturing, food and beverages, warehousing and logistics, power, textiles, and even railways. No matter the sector, MBEL brings its expert engineering and innovative approach to every project. The company is all set to raise a total of 650 crore rupees through this IPO. The issue price band has been set between 366 and 385 rupees per share. This means investors can apply for shares within this price range. The IPO will open on July 30 and it will close 2 days later on August 1. Once the IPO closes, the tentative allotment date is set for August 4. Finally, the big day, the listing date, is August 6. Now let's take a detailed look at the conservative discounted cash flow model for M&B Engineering. In this model, I have assumed that the company's revenues will grow at a compounded rate of 15% annually, while the EBITDA margin will gradually decline from 14% to 12% over time. The analysis begins with projected revenues, which start at 1,146 crores in year 1 and grow steadily to 4,033 crores by year 10, reaching 4,214 crores in the terminal year. This growth is supported by the 15% CAGR assumption. Next, we subtract the cost of goods sold, or COGS, which reflects the direct production expenses. COGS also increases over time, beginning at 990 crores and rising to 3,541 crores by year 10. Depreciation, a non-cash charge representing asset wear and tear, also grows gradually from 14 crores to 39 crores. Moving to operating profit, or EBIT, we see it increase from 142 crores in year 1 to 454 crores in year 10, indicating that despite margin pressure, operating performance remains strong. The net operating profit after tax, or EBIT after tax, ranges from 107 crores to 342 crores over the forecast period. We then add back depreciation, since it's a non-cash item, to arrive at a true picture of available cash. Capital spending, which reflects investment in assets and infrastructure, ranges between 51 crores and 104 crores annually, showing the company's continued focus on growth. The change in working capital varies across the years. Sometimes it's a cash outflow and in others, a release of cash, depending on the company's short-term operational needs. After factoring in all these elements, we arrive at free cash flow to the firm, FCFF, which is the actual cash available to investors. This grows from 40 crores in year 1 to 329 crores in year 10, with 365 crores in the terminal year. Finally, we discount these future cash flows to their present value using the 10.8% discount rate. This gives us a series of present values starting from 36 crores in year 1 to 122 crores in year 10. After projecting the free cash flows to the firm over a 10-year high-growth phase and discounting them at a rate of 10%, we calculated the present value of cash flows during this high-growth period to be 882 crores. In addition to that, the present value of the terminal value, which represents the company's expected value beyond year 10, comes out to 2,713 crores. By adding both components together, we arrive at the total value of the firm, which stands at 3,595 crores. Next, we deduct the company's market value of debt, which is 131 crores, to arrive at the market value of equity, estimated at 3,464 crores. But we're not done yet. We also add back cash and cash equivalents worth 30 crores. This gives us a final equity value attributable to common shareholders of 3,493 crores. Now, dividing this total equity value by the number of outstanding shares, which is 5.71 crores, we get the intrinsic value per share, which comes out to approximately 612 rupees. Based on our conservative DCF model, estimated the intrinsic value per share of M&B Engineering is to be around 612 rupees. This valuation is built on cautious assumptions, including a 15% annual revenue growth rate and a gradual decline in EBITDA margin from 14% to 12%. For context, the company is expected to list at a price of approximately 385 rupees per share. That represents a significant difference when compared to the intrinsic value derived from our conservative projections. It's important to note that this analysis is purely for educational and informational purposes. This is not a recommendation to buy. Now let's see the base case. In the base case scenario, I have assumed that revenues will grow at a 20% compounded annual rate, and EBITDA margins will remain stable throughout the projection period. This scenario reflects a confident yet reasonable growth path for the company, considering its sectoral leadership and expanding market presence. Starting with revenues, the model shows a steady rise from 1,196 crores in year 1 to 6,172 crores by year 10, reaching 6,449 crores in the terminal year. This sharp growth flows through to operating performance. COGS, or cost of goods sold, scales accordingly from 1,033 crores in year 1 to 5,271 crores in year 10, maintaining profitability ratios in line with expectations. Depreciation increases over time as the company invests more in assets, starting at 14 crores and going up to 42 crores by year 10. Earnings before interest and tax, or EBIT, show strong expansion, moving from 149 crores in the first year to 859 crores in year 10. After applying taxes, we arrive at EBIT after tax, or net operating profit, which grows from 112 crores to 649 crores over the 10-year period. We then add back depreciation to reflect actual cash earnings. Capital spending remains consistent, reflecting the company's ongoing investment in infrastructure, and ranges from 51 crores to 113 crores. The working capital changes are variable. In some years, they are negative, indicating that cash is tied up in business operations, and in others, they are positive, such as 99 crores in year 7, reflecting a release of cash. As a result of these operating assumptions, free cash flow to the firm, or FCFF, grows substantially from 36 crores in year 1 to 680 crores in year 10, showing the company's high cash-generating potential under steady margins and strong top-line growth. Finally, we discount these cash flows back to their present value. The present value of each year's cash flow starts at 32 crores and climbs to 252 crores in the final year. The present value of free cash flows during the high-growth phase works out to 1,519 crores. In addition to that, the present value of the terminal value, which represents the company's value beyond year 10, is estimated at 4,988 crores. Adding both gives us the total value of the firm, which stands at 6,507 crores. From this total, we subtract the market value of debt, which is 131 crores, to get the market value of equity, coming in at 6,376 crores. When we add the company's cash and cash equivalents worth 30 crores, we arrive at the final equity value attributable to common shareholders, which is 6,406 crores. Finally, we divide this number by the total number of outstanding shares, which is 5.71 crores, to get the intrinsic value per share. Under this base case, the share is valued at approximately 1,122 rupees, which is way above its listing price. Now let's explore the optimistic scenario in our valuation. In this model, I have assumed that the company's revenues will grow at 25% compound annual rate for the next 10 years, supported by strong demand, sector expansion, and the company's leadership in pre-engineered buildings and roofing systems. Not only that, but the EBITDA margin is expected to improve, increasing from 14% to 17% over the projection period. This scenario reflects the potential upside if MBEL executes perfectly, scales efficiently, and expands into higher margin projects and geographies. We start with revenues, which grow significantly, from 1,246 crores in year 1 to 9,283 crores in year 10, eventually hitting 9,701 crores in the terminal year. This rapid top-line growth is supported by consistently rising operational scale. As revenues grow, COGS, or cost of goods sold, also increases but remains under control, moving from 1,077 crores to 7,705 crores by year 10. The company becomes more operationally efficient, reflected in a higher EBIT, or earnings before interest and tax, which grows from 156 crores in year 1 to a staggering 1,533 crores in year 10, and peaks at 1,601 crores in the terminal year. After subtracting taxes, net operating profit after tax (NOPAT) increases from 118 crores to 1,157 crores over the decade. We then add back depreciation, a non-cash expense which also increases with capital investment, rising from 14 crores to 46 crores over the forecast. The total cash profits thus rise dramatically, reflecting both top-line growth and improving margins. Capital spending, which reflects investments into new facilities, equipment, and infrastructure, ranges from 51 crores to 123 crores across the years, necessary for supporting rapid expansion. Meanwhile, working capital changes are dynamic, as expected in a high-growth environment. In some years, working capital is released, like in year 7 with -95 crores, boosting free cash flows. In other years, additional capital is tied up in operations, like in year 6 and year 9. All of this leads us to the most important number, free cash flow to the firm, FCFF. Under this optimistic scenario, FCFF rises rapidly from 31 crores in year 1 to 1,265 crores in year 10, with 1,246 crores in the terminal year. These figures show that MBEL could become a major cash-generating machine if both revenue growth and margin expansion play out as expected. Finally, we discount these cash flows, bringing them back to today's value. The present value of cash flows increases each year, starting from 28 crores in year 1 and hitting 469 crores in year 10. The present value of free cash flows during the high-growth phase adds up to 2,282 crores. To this, we add the present value of the terminal value, which reflects the company's worth beyond the 10-year forecast. That figure stands at 9,252 crores. Together, these give us the total value of the firm, which comes out to 11,534 crores. Next, we subtract the market value of debt, estimated at 131 crores, to arrive at the market value of equity, which is 11,403 crores. We then add back cash and cash equivalents, valued at around 30 crores, giving us a final equity value in common stock of 11,432 crores. Finally, dividing this equity value by the total number of outstanding shares, which is 5.71 crores, we get an intrinsic value per share of approximately 2,002 rupees. Based on DCF analysis, the intrinsic value per share of M&B Engineering appears to be higher than the expected listing price of rupee 385 across all three valuation scenarios. In the conservative case, we estimate the value to be around rupee 612 per share. The base case, which assumes stable EBITDA margins and 20% annual revenue growth, yields a value of approximately Rupee 1,122 per share. In the optimistic case with stronger revenue growth and margin expansion, the intrinsic value rises to about Rupee 2,002 per share. While these figures suggest a potential upside, it is important to emphasize that this analysis is for educational purposes only and should not be considered as a recommendation to buy any security. I am not a Securities and Exchange Board of India registered investment advisor. Please consult your financial advisor before making any investment decisions.